Good morning. My name is Lynn Gillette. I'm the president of the Silicon Valley chapter of AAII, and I welcome you to what's going to be an excellent presentation on taxes. It's the November main event, and we do taxes on that date every year. A couple of comments. We're going to have a fairly good-sized crowd, so please type your questions into the chat window. And Claudia will, at certain points, break and we'll answer questions and then go back to the presentation. Claudia is one of a number of really good tax presenters that we have over the years. And I'm going to read something from her biography and then make a couple of comments. First of all, the January 13th meeting will be by Delta Investing, and that topic will be 2024 economy and where is the market going. The precise title will, of course, be sent to you later. Claudia Hill is an enrolled agent, nationally recognized tax professional, and frequent lecturer on taxation of individuals and representation before the IRS. She is editor-in-chief of the Journal of Tax Practices and Procedures, co-author of the CCH Expert Treatise, Tax Practice and Procedures, and a frequent presenter for audio and in-person CPE seminars nationwide. Hill coordinates a, quote, dream team of tax controversy advisors, unquote, for the IRS Watchdog blog on Forbes magazine. She was named top 10 nominee by Tax Analyst as 2011 Person of the Year. Claudia asked for the slide deck for our previous presentation by James Ward on estate planning so she could coordinate her coverage with the one that came before. And anyway, let's turn the time over to Claudia. And by the way, there will be a survey during the break, and the two topics that will be covered will be 2023 year-end tax planning and then a favorite subject of mine, tax-efficient retirement strategies. So Claudia, you have the forum.
Thank you. Let's see. So I'm going to tell you what I expect to cover today. And of course, we're going to spend most of our stuff on what's changed this year, what to consider when we do year-end planning. So we're going to be talking about the tax rates and how those have changed over the years, and deductions not to be overlooked, year-end planning, RMDs, required minimum distributions. My goodness, there's been enough changes in that area that there's plenty to talk about there, and the importance of knowing how they work and the craziness with the changes related to inherited IRAs. Let's see. Then we will cover a very, very short snippet on estate and gift taxes, just to raise some awareness of what's happening with those over the next 2 years and why you may want to take some action sooner rather than later. Okay, we're off then to who must file. Now, looking at the chart on the screen, when it comes to who must file, you look at these, and these are some amazing numbers, I think, in terms of married filing a joint return. You don't even have to file a tax return until you hit 30,700 if both of you are over 65. If both of you are under 65, it's 27,007. These are the thresholds. Now, why would they be that high? Because a few years ago, with the Tax Cuts and Jobs Act, the government conceptually, at least this is what they said they were trying to do, combined the personal exemption and the standard deduction. And one of the goals they had with that legislation was to eliminate the number of people who were having to file Schedule A. Our former taxpayer advocate, you probably recall the name Nina Olson, she was a strong advocate for lower income and middle income taxpayers. And one of the things that she felt was unfair was that the deductions that homeowners gets, okay? Homeowners got deductions for interest on their home, while a person struggling to pay rent got nothing. Okay? So part of her goal was in supporting this expanded exemption amount in the hopes that it would be, quote, fairer to everyone. Well, when it comes to your inability to deduct more than $10,000 a year in state taxes, I'll let you think about how fair you feel that that legislation was. But more comments on that one a little bit later. So the standard deduction again, 30,700. You occasionally will run into situations where you also must file, even if you haven't hit these thresholds. And one of them that we probably see most frequently around here is our self-employed people. Because if you're self-employed, you have to file once your self-employed income exceeds $432. And that's because you may not owe any income tax, but you're going to owe self-employment tax, which covers your Social Security and Medicare. So that would be an exception to these rules. And yeah, okay. We will file, we will get the returns in. There's a few other more unique situations where you should file. Occasionally people say, I tell clients, you don't even have to file. And they say, well, I will feel more comfortable filing because I know that I've done that the last 50 years. I want to file a tax return. Okay. There's nothing that says that you can't file, even if you are below these thresholds. Tax brackets for income earned in 2023. Now, this is something that's kind of amazing as we walk through it. Let's start at the bottom here. We have a 0% bracket. A 0% bracket for a single filer would be someone whose taxable income, that's after that standard deduction, was 11,000 or less. I mean, I rounded. It's got 10,999.99, but 11 that much or less. And notice for married filing jointly, the number is exactly twice that. Okay. If we move up a category to the 12% bracket, we have the same thing, 11,000 to 44,724, and the married jointly is twice that. We move up to 22% bracket, and we see that it is twice that on the married filing jointly. Now, what's going on here is the government's attempt to address the marriage penalty. Years ago, these numbers were not twice the amount of the lower brackets there at all. And we complained a lot about, gee, two people that are single pay less taxes than two people that marry each other. So the government tried to address this. And if you go through this chart, you can clearly see we get up to the 24% bracket for singles going up to 182. And that is a duplicate over on the married filing jointly. But my goodness, if you make more than that magic number as a single person, 182.1, and a joint filer of 364, your marriage penalty is back on in spades, because as it proceeds up to the highest bracket, you enter the 37% highest bracket for regular income taxes and not counting all the extra things that get added at there. Where a single person, it doesn't enter it till 578,000. Married jointly, you get there at 693. Okay. So marriage penalty works if you are a moderate income taxpayer, but as you get to be a higher income taxpayer, you pay more tax if you're married. Just yeah. But wait, that's not the only tax you pay. There's more. If part of your income is a capital gains, it doesn't have those rates that we just looked at being applied to it. Okay. You actually can have what's called a zero tax bracket applied to it for capital gains. A single person, if the taxable income, and this is the big thing, if the taxable income, not the capital gain, but the taxable income is under 44,625, any capital gains or qualified dividends, and you know we love those, especially our retirees love those because we get these special breaks applied to them. Up to 44,625, no tax. Wow. And we get up to the single taxpayer, and that 44,625 becomes the bracket for the 15% tax rate, which on the surface goes all the way up to $492,300. Oh my goodness, that looks beautiful. Okay. But we're talking about qualified dividends and capital gains. And for single people, it hits the 20% at 492. But you're going to see in a moment that that's not all, okay? But there's still beautiful rates when you compare them to the regular tax rates we had over here, which by the time you're at 400 and some odd thousand, you're at 35. And over here, gosh, you're still at the 15% bracket if you're single, okay? So we have special rates that apply to capital gains. And you can see that married filing separately doesn't have the same structure as the singles do on this one either, because married filing separately, although the beginning of it is the same at the 44,625 threshold, when it comes to the 15% bracket, instead of going up to 492,000, it stops at 276, and that goes to the 20%. I want to call your attention to estates and trusts. Now, estates and trusts, you may have heard people say they pay the highest tax rates of any entity. Well, look what they do with capital gains. For the coming year, a trust that retains capital gains, and if you think about it, most trusts have investment assets in them. That's 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 what they're made up of, is investment assets. And so you see lots of interest, dividends, capital gains, and a trust that or a state that retains that income is going to hit this 20% bracket on the capital gains and qualified dividends at 14,651. So that's why people who have discretion in their trusts and estates, the taxability follows the money. The taxability follows the money with estates and trusts. If you're the beneficiary of an estate and trust, to the extent that the trust or estate releases that income to you, it'll get taxed at your rates. To the extent that it's retained inside that trust entity or that estate box, it gets taxed at these rates. Okay. So that gives you a little insight if you were thinking of creating a trust or that you're a beneficiary of an estate or trust, and that you need to talk to the trustee, fiduciary, and let them know that if there's discretion, ask them if your trust has discretion in terms of its distributions. I've had clients where when we have a trust that we're working with that is like this, we will do a federal return, federal and California individual, and a federal and California trust. And then we'll say, well, what if we left the money there? What would we pay between the two entities? And what if we made a distribution? Who would pay the least tax on that extra amount of money? And we'd make that decision from year to year. So understand the nature of the trust if you're a beneficiary of a trust, and understand that the tax rates on money that stays inside those trusts can go up fairly quick. Yep, because when you're at this same 14,650 for capital gains tax, you're at the 37% for ordinary income that stays inside there. And that's not all when it comes to tax rates, things to be aware of. The capital gains rates, this is just a quick variety of types of capital gains rates. And that's because we're going to talk about one about net investment income in a moment. You can see a 3.8 get added to the top 20. Well, there are times where the 3.8 gets added to the 15. I should have stuck in an 18.8% in here too. But I wanted to call your attention to the 25 and the 28% bracket. The 25% rate is the one that applies to depreciation. If you have rentals, for example, and you sell a rental, you don't use all of the normal capital gains rates. Well, I mean, you do use all the normal capital gains rates, but the portion that is depreciation that you've taken over the years of ownership, that portion that is depreciation comes back at the 25% rate. The gain from appreciation in the sale of that rental is going to be subject to the 0, 10, 15, 18.3, 23.8 as we go through that. And then the 28% rate that we have here on the capital gains, and these are all long-term rates, okay? Because short-term rates are treated as regular ordinary income rates on those. But the 28% refers to gains from collectibles, and collectibles not only includes things like artworks, but if you invest in funds that are made up of, I've seen these as ETFs frequently, or grantor trust arrangements where they hold gold or silver. Gold and silver are considered collectibles. and any gains on those are subject to the higher 28% rate instead of the normal capital gains rates. So that gives a little bit more insight into that piece. And the reason it's important to know all of these pieces is that you make assumptions as you're doing your year-end planning about what you're likely to need to reserve for taxes. And understanding that the rate structure helps give you a better grasp on um, in doing that planning as you go into it. So NII, net investment income. A moment ago, I said for certain people, they get to add an extra 3.8% of the net investment income to their regular tax rates that we've seen so far. And in fact, they fill out a separate form to do that and to add it on. And if you're filing a married filing joint return, the threshold for when that extra 3.8 starts is 250,000. For a single person, it's 200. See any marriage penalty in that one? Okay, so single or head of household, this extra 3.8 starts at 200. Joint return, it starts at 250. But again, notice that for a trust or estate, which also gets to pay this kind of tax, it's only 14,500. Okay. So that's the net investment income tax. There's two more that I got to mention here before we get off the subject of tax rates, and that is a Medicare surtax. Both the net investment income tax, the 3.8, and the 0.9 Medicare surtax came to us as part of the Tax Cuts and Jobs Acts when they were restructuring everything and trying to lower the tax brackets. Well, they lowered the tax brackets for some people. And since it didn't create enough revenue to pay the bills, okay, they added on these extra pieces to help pay for the Affordable Care Act. The 9.9% Medicare surtax applies to wages and self-employment income over the following thresholds: 200 for a single individual, 250 for a married filing joint return. These things came into the law back in 2017, could be plus or minus in there a year. But the key thing to think about here is that these threshold amounts that are subject to this, most of your income tax rates are indexed for inflation. And that's why your regular, the ones that we started with, the regular tax rates, those are the ones that are indexed for inflation. These add-on taxes with the thresholds that we've talked about here, with the nice round even numbers, those thresholds were never indexed for inflation. Can you imagine how many more people get to pay these kind of taxes each year because they're not indexed for inflation? Okay. Now, self-employment tax, ooh, this is a tough one because the government's looking for money to help make sure that Social Security doesn't run out of funds. And so we've seen a dramatic increase in the last couple of years of the self-employment tax threshold. And by what I mean by that is the amount of income that's subject to self-employment tax. Now, the main self-employment tax, which is the Social Security component, is a 12.4% rate applied to the first $160,200 of net business income. You can see tax returns where the people are paying no tax except self-employment tax. And when you figure that 12.4, that's the equivalent to an employee's 6.2. I was explaining to a grandson the other day that he was currently between employment jobs and he was being asked to do freelance work. And he said, they're offering me the same kind of money I was making before. And I said, no, they're not, because before your employer was paying 6.2% of this, and now you're going to get to pay the extra. And before you were being offered certain fringe benefits, and you're not offered any now. He says, so it isn't apples and apples when you do these calculations. Self-employed people are responsible for the full load on their Social Security and Medicare. Now we have a ceiling of the 160,200 for the Social Security component, but there is no ceiling on the Medicare component, and that's 2.9% on all earnings on the Medicare component. If you're an employee, you see it as 1.45, but as a self-employed person, it's the 2.9. Whoa. But in spite of all of that, there's still one more item that we need to take into consideration, especially if you're receiving Social Security, and that is It's not it's not a tax per se, but senior taxpayers have another reason to moderate their income, and that's because the amount of Medicare premium that they pay is subject to adjustment on an annual basis based on their modified adjusted gross income. Now, if you can see the chart here, excuse me, beneficiaries who file individual returns and their modified adjusted gross income is under 103,000, they pay the base level at Social Security Medicare premium, excuse me, of $174.70 going into this next year. I think this is the current year. I'm trying to remember where I clipped it from. 93% of all the people that receive Medicare and Social Security fall into that very first category. Isn't that hard to believe? Because 90, and maybe that's part of the reason we don't have that many people in that category living in this valley. Okay, but 93% of the people in the country who receive Social Security Medicare have taxable adjusted gross income of less than 103. For that 7% that is above that level, that premium is going to go up in various stages and can reach $595 per month. And think about it. If you're married, this is duplicated because each of you get to pay for the Medicare premium. So the thresholds here to watch are below 103,000. The next level is between 103,000 and 129. You have a $69.90 adjustment per month. Once that modified AGI gets up to 129, between that and 161, the extra per month is 174.70. Greater than 161, less than 193 goes to 279, all the way up to if the modified adjusted gross income is over 500,000, you're paying an extra $419.30 a month. My goodness, I looked at this and I thought, could I buy regular insurance? You know, and would it be any better? Because most of the seniors that I see pay Medicare as well as buy a supplemental policy. So medical, including insurance, and this is part of the reason why, is becoming one of the biggest components that I see. And we'll talk about it again later when we talk about the itemized deductions, partially because of this. Okay. So be aware that this exists. And for those of you who are thinking, how did it get that high? Okay, why did it get that high? It got that high when George Bush II was president. He supported this because it expanded the drug coverage and made drug coverage available to everybody where it hadn't necessarily been before. And that's good news and bad because a lot of people benefited from it. But he made sure also that it passed, but it did not go into effect until he left office, and because there was more than a 2-year delay between the passage of this legislation. I followed tax legislation for so many years. I still have all of these little pieces embedded in my head. Okay, let's see where we will move to next. Okay. I'm going to ask Lynn and Deborah, are there any questions up to this point, or shall we move on?
There are a couple questions.
Okay, you want to go ahead with that?
The first is, what do you mean by retained in the trust?
Retained in the trust. A trust each year, most trusts have a choice as to whether they distribute funds out to the beneficiary or they keep them inside the trust. Okay. I think the most frequent type of trust I see mandates, especially like bypass trust for a spouse that passed away, mandates that all the income get distributed to the beneficiary. Okay. In that case, the trust isn't keeping interest and dividends, it's keeping capital gains because that's part of the body of the trust, but the income flushes out. So retained in the trust is of the total picture of income that came in during the year. How much is going to get moved out to the beneficiary versus stay inside the trust. There's no double taxation with trusts. The taxation follows the money. So if the money stays in the trust pays taxes on it. If the money moves out, it moves out and the beneficiary pays taxes on it. Now, that's the general rule. There are some that because they say it's to be distributed, even if a person fails to distribute it, the beneficiary gets to pay taxes on it. But trust taxation is just it's different than individual. It's really a specialty area, and where we live in this valley, there's been a tendency to the number of trusts have proliferated. So, um, so we see a lot more of them. And as the greatest generation there ever was moves through the timeline, we are seeing more deaths, and with more deaths, we see the more trusts being created. So maybe that's why we see so many. Was there another question,
Two more.
Lynn? Okay.
Isn't
Uh,
Bitcoin and other cryptos a collectible?
Bitcoin does not qualify because it's not considered to be a capital asset. I don't know that I would call it another collectible because I've never seen anything that sets the upper tax rate at 28% on that. But you're correct in that Bitcoin is unique. It doesn't qualify for what we think of as normal capital gains treatment on things. That's good news and bad because it's not limited by the losses on an annual basis either because of that. But I should have put together a little piece on crypto because the government is still in the hot button category. Our government has eked out little dabs of regulations over the years, not really enough to make us feel comfortable. But oh my goodness, every year, do not overlook checking that box at the top of the 1040. And the box I'm referring to there is the one that says, did you have any transactions in virtual currency? It no longer says, do you own it? Okay. It says, is there any transactions that were made during the year? And absolutely check yes on that. I saw a practitioner recently say, oh, don't do that, you're going to get audited. And my response on it is failure to disclose that you have it, okay, can lead to the kinds of problems we had several years ago, I believe, because IRS is getting this, is continuing to be successful in getting the names and forcing the crypto agencies to have to file information reporting. So they've got your name if you're out there trying to do this without reporting it. And at the point that they get the resources to do it with, there'll be more and more contacts going out, tapping you on the shoulder for failure to report. I don't know how many of you remember, it was a big deal in the tax community, failure to report that you had a foreign bank account several years ago. Well, to me, this crypto question on the top of the 1040 is comparable to that box that you have to check on the bottom of Schedule B saying, yes, I have a foreign account. You may have a foreign account and you may keep $5,000 in it and you can go outside of the country because it's your vacation money. Okay, that's fine. You don't have to file any separate additional forms to the government if you only got $5,000 in it because the threshold is still at 10. But you do need to say, yes, I've got the account. No, I don't have to file the form. And the issue with crypto is make sure you check that box because what happened to all of those unfortunate people who didn't know about the box on their foreign accounts is the government said that that was an intentional and that the return was not closed to audit because they didn't provide complete information. You don't want to be anywhere near that if it were to blow up for you. So follow those rules. I recall seeing in the last couple of weeks another missive that came out for the government providing more information about crypto, but I have not incorporated it in today's session. One more question and we're going to move on.
Okay. If one person has W-2 income over 162K and paid employment tax through work, and he also has self-employment job, does he need to pay self-employment tax as well?
Okay, so once you've met the threshold under the self-employment tax, if you have wages comparable to that, then for that 12.6% we have It's the starting point. Let me go back to that slide. Let's see. Okay, 12.4. Okay, so up to the 12.4, which is 6.2 that the employer paid, and he paid that, and he's already satisfied it, then he does not have to pay the 12.4 over again on the self-employment tax. But the combination of the two things is essentially all of that self-employment income falls into the category now of 2.9%. Okay, so everything would still be subject to 2.9 on the Medicare component because it just keeps going there. Okay.
If
And
someone has two jobs and ends up with over that amount, it gets refunded through the tax return, correct?
on a wage employee, yes, a
Yes.
wage employee who has two jobs and has had duplicate base level, this 100 within that 162,200, okay, if they've paid that 6.2 that they would have paid through employee withholding, the excess over the maximum on 162,200 becomes refundable to them. And let's see, it should be automatic, meaning they need to make sure they put it in there. But if they fail to put it in there, I'm thinking, how long is it going to take IRS to send them a letter asking if they'd like to get their money back? Yeah. So if you've had a, if this has been your situation and you failed to say, whoa, I'm entitled to a refund on this thing, then I would say file an amended return, get that money back. Okay. Yes. Okay. We are now going to move to, is it still worthwhile to itemize deductions? We started off talking about the personal exemption level, and I said, this is your standard deduction. So, and you saw how large that was too. It was over 30,000 for seniors at this point, two seniors on a joint return. Is it still worthwhile to itemize? And with that in mind, what I'm going to suggest to you is maybe not every year, okay, but there are ways that we can bunch deductions one year, delay them the next. We can make it worthwhile to occasionally, in some years, go through the threshold so that we have more in one year and less in the other, and actually get a better outcome with structuring our timing. So let's see what that means in terms of ideas on how we can do this. What's left to itemize? Well, we can itemize the amount that we pay for taxes. So that includes our property taxes, our DMV fees, our state of California fees, but that's limited to $10,000. Now, hang on, because if that component that makes this up that's limited to $10,000 includes more than $10,000 in property taxes and DMV fees, those are still deductible without limit over on your California return. So a large proportion of the clients I work with, we take the standard deduction on the federal, but we itemize on California. So it's still worthwhile to say, time out, I'm going to calculate all these pieces so that I can see if I can get a better break and save a few bucks on California. California doesn't have really low tax rates. It doesn't take a lot to be in the 9.3, and then it starts taking good income to be in the 10.3, 11.3 brackets, you know. So taxes, although they're limited 10,000, we want to take our whole 10 worth. Residence interest. Now, residence interest is within limits, and the government has stepped back a little bit in terms of maximum interest allowable on a loan. At the same year that they put in this larger standard deduction, they also reduced the maximum interest you can have for property acquired after that legislation. So for people who had the $1 million loan on their house before the law went into effect that changed all these things, they can continue to deduct that $1 million of interest. But having acquired your home more recently, you're limited to the 750,000. We used to, on the federal, have an equity line of credit, an extra 100,000 that could be used to do anything we wanted to, but it was secured by the house, and we could take the interest on that loan too. Um, doesn't exist on the federal at all, so that line of credit. But both of these things, this switch to the 750, this equity line of credit, California never changed that. California never changed it. So if you have one of these high mortgages, okay, then you need to do your calculations twice, one for federal, one for California, and look at the specific limitations that they each have and follow those limitations. Don't just assume that, gee, it's not worthwhile for me to do this for federal. I'm not going to bother on California. Especially if you have mortgage interest, my goodness, it could make a big difference on that one. Okay. Charitable contributions. We're going to spend a little bit more talking about those, and those are certainly ones to itemize. The fourth category that's left to itemize is medical expenses. Okay. And I want to spend a few minutes talking about this because this category is the one that I've seen that has grown the fastest as people age. Okay. Well, it makes sense. I mean, think about just a moment ago when I was talking about the Social Security and the Medicare premiums. Those Medicare premiums fall into the health and long-term care insurance, this category at the top there. A lot of people are buying long-term care insurance. And when I say within limits on that, there's a maximum that you can deduct on a yearly basis based on age for the long-term care premiums. Most of the premiums I see are within that, I can tell you. So it's worth looking into it. Long-term care, regular uh, insurance for many people in this valley, we have supplemental. I have clients who have concierge doctors and they pay them a flat amount per month regardless. We add that into the pool. What you paid through your that that awful Medicare premium that got up to $500 a month for some people. Oh my goodness, that's part of the insurances and should go into these categories. The medical care itself, because in spite of having all of that money paid for insurance, it's unusual for me to find someone who has nothing out of pocket. It's great when you do, but there's often some categories. For example, the most frequent out of pocket medical related that I see for the aging seniors is dental, okay? Because there are very few that have good quality dental insurance. And those procedures, wow. So medical care, dental care fall into this. And one of the things that I know that we need to be aware of under medical care, a number of people are looking at how do I make sure that I'm cared for as I age and go through different stages of aging. So a person who moves into a continuing care facility may find out that that continuing care facility has a base amount, maybe it's 10%, maybe 13% on an annual basis of the monthly fees that are paid is actually going to medical. Okay. And then as they progress through the different stages at a continuing care facility, you first start out, you're probably getting only the base medical that's in the monthly, but then you enter into what's called a menu of additional care items that you may need, and those become medical. But the number one biggest expense that I see is when a client gets to assisted living, where the nature of their um, needs means that they cannot live independently by themselves any longer, and they've lost some of the activities of daily living, and because they've lost those, they qualify one to tap into their long-term care policy, but two, 100% of their medical becomes deductible. I tell people at that point, hey, you don't have a tax problem anymore. You have a money utilization problem because of making sure that we've planned to take care of these needs as you go forward. But 100% of the assisted living becomes a medical expense, and you will be itemizing if that's your case. A few years, the government tried to change the threshold, the amount that you have to absorb before you get to take a deduction, and they changed it to 10. It it made it to the tax forms, but it never made it into effect because the next Congress came in and reversed it. So we're still at 7.5% of the threshold that you have to absorb before you get to take the deduction as that continues. Let's see. So as I said, the long-term care is the category that is increasing exponentially. And let's see if there's any other pieces here. Ooh, I'm going to share one more thing. Know the activities of daily living. One of my clients moved into a continuing care facility. Okay. And she asked me this question, and I thought, well, you don't really have a problem now. Aren't you living rather independently at this point? She goes, I am, but I meet the criteria of two of the activities of daily living that are compromised at this point. So she contacted her long term care insurer and they said, yes, you qualify. And they started paying out. Now, why is this unique? Okay. One, she didn't wait until she was great of age and closer to not living much longer to claim this money because none of us know how long we're going to have. And a lot of my clients who do have long term care, uh, they have a fixed dollar amount over their lifetime that they will be able to use that for. Okay. So she essentially tapped into it while she only had a few of the disabling conditions rather than waiting to the point that she was totally disabled. Why does this make a difference? It means that she's not tapping into her own investment reserves, and those are being allowed to continue to grow during this time that she uses up. And I hope and I hope she uses it all up and then goes on into tapping her others, because that would mean that she ended up living to even a greater, riper old age. But it was a concept and a thought. So I want to plant this in your head if you're looking at these kind of decisions or at the point that you start looking at these decisions about whether you draw it and make sure you get to use it up before you die. Because a lot of people, they're glad they have it when it clicks in, but they wait so long for to start drawing on it that the duration of the payments doesn't use up everything that they were entitled to. Let's go to another observation on the issues we face with itemizing, and that's the deductions for non-business state and local taxes, where we've talked about it being capped at the 10%. It's referred to SALT, state and local tax. That's what SALT stands for, SALT limitation. And something that has cropped up in the last 2 years, where I've seen it start taking off like a wildfire, is the ability of entities to do a pass-through entity workaround to this limitation. Let me tell you a little bit about how that works. Pass-through entities, like being in a partnership, okay, and that's the main place I see it used. A partnership, you have a general partner who receives compensation for the work they do, and all of that, the partnership pays no taxes. All of that flushes through to their personal 1040. A few years ago, people with creative minds went to the government and said, well, they're paying taxes on their business earnings and stuff here. Why can't we, a partnership, withhold on that money and pay it directly to the state for them? And in doing so, it gets around the $10,000 limitation of them putting it on as an itemized deduction on their personal return. Yeah, and it works. And essentially what happens, I'll give you an example. If their partnership is paying them out $200,000 and the partnership has withheld $10,000 to go to the state of California to essentially pay taxes on their California income earned on that $200,000 of income, okay, then that funds that went to California is taken as a deduction against the federal income they had to report. So if they earned 200,000, their California earnings are going to say $200,000. Their federal earnings is going to say $200,000 less the taxes that the entity paid the state of California. they don't get to take a deduction on their personal return, for more than $10,000. And I imagine that person also paid California property taxes and DMV fees and maybe some other types of taxes from other sources. But the ability to still deduct those because you've got the biggest bulk coming through the partnership is saving them income taxes on the federal side, okay, and giving them this break that the rest of us who are not members of pass-through entities are able to use. So Tax Cuts and Jobs Act, still looking for a solution to the SALT limitation, the state and local tax limitation. But I want to remind you of the flip side of this. And when I say flip side of it, if you are one of the people who, before Tax Cuts and Jobs Act, every year you paid AMT because your deduction for state and local taxes was so large. Okay? Remember back then, AMT was a big issue, and a whole lot of people in California were having to pay that every year. And when they were, it meant they were getting no benefit because for the alternative minimum tax, you could not deduct state and local taxes in the first place. Okay. So we eliminate, reduce state and local taxes, alternative minimum tax virtually disappears. I have so few people, and I used to do a whole lot of returns with AMT on them every year until we came down to this SALT limitation. So it was smoke and mirrors to some extent. Were you really better off under the old system? I'm not sure. Okay. But be aware that if you are a member of an entity, S corp, partnership, especially partnerships, um, and you get earnings from that on a every year basis because you're working inside that entity, ask your accountants to take a look at the pass-through entity workaround to help save you some bucks because that one's worth it. I want to comment on charitable contributions because when it comes to itemized deductions, there's a priority in what kind of of charitable deductions we want to make. Because of the concern that taxpayers would reduce their charitable giving once Congress came up with this new higher, beefier standard deduction, Congress increased the amount that could be given away annually to 60% of AGI instead of 50%. Well, you and I know we it's unusual to see someone who's giving away more than 50% in the first place, but 60% is available. And if you are one of the people that does give high amounts away every year, this 60% AGI is set to drop. It's going to drop back to the 50% in the year 2020. It expires in 2025, so I guess it would be 2026 that it's gone. Okay. So charitable contributions, beware that they are not locked in cement. Okay, after 2025 is when it's going to drop back. I had a note to myself. Okay. Which brings me to some comments on charitable planning. Okay. There are three primary ways people can do charitable planning. One of them is what I call year-end bunching. And by year-end bunching, this would be a way of every other year, okay, we would go for a full year and not make charitable contributions because we plan to use the standard deduction and it's so high. But on the alternate years, we would bunch all the contributions from last year and this year together to see if we can get past that threshold. That's one approach. Another approach is to do your year-end bunching using donor-advised funds. I think donor-advised funds are beautiful because they allow you a way to transfer appreciated securities into a donor-advised fund. You'll find these at almost every brokerage. Vanguard has it, Schwab has it, Fidelity has it, donor-advised funds where you give them, and what I use Schwab. I'm not trying to advertise Schwab, but I'm able to just simply at a point in the year that I want to make these contributions, I can swipe over and say, send this many shares of this particular stock to my donor advised fund. And it, boom, like it happens very, very quickly. Okay. That gives me a big charitable contribution all at one time. And instead of having to try to bunch everything at year end using the donor advised fund, it's kind of doing the same thing. I can put into my donor advised fund the funds that I would normally give to charities over the next several years, and then have the checks dispersed from the donor advised fund over time. Now, once that fund money is out of my account, I'm not going to get it back. So I get the charitable contribution for the whole thing at the time that I move the stock into the donor advised funds. I don't get an additional contribution. I do not get an additional contribution when the funds come out of the donor advised funds and get to the charity, even if they send you a nice thank you letter. Okay. And I say that because I've had clients who've gotten confused and will put in with their tax documents the receipts from thank you letters from the people who receive donor advised funds. And I have to try to watch for that so it doesn't happen twice. Now, the third category when it comes to charitable planning that I have here, using QCDs. QCDs are qualified charitable deductions. QCDs come out of your IRA account once you reach the age that you qualify to make a QCD. We're going to be talking about how IRS has changed the age for when you have to take your IRA distribution. And they've now got it up to 73, I believe. But QCDs can start at age 70 and a half. Okay. So here's a picture. Taxpayer has to take a distribution from the $40,000 distribution from their IRA. Okay. They want to do $10,000 in charitable contributions. They've done that every year. But when they do that 10,000 and they take it as a deduction on their Schedule A, it doesn't beat the 30,000 plus threshold. Okay. So did they get any tax benefit of it? No, they paid taxes on the whole $10,000. If instead of taking it and putting it in their account and then sending it to the charity, they take it from the account and have that account, because it's got to come directly from the account. They've got to have the account send the money to the charitable beneficiary. That is a qualified charitable donation. That reduces the amount of the IRA that they have to report. So if they have 40,000 that they had to take as a distribution, 10,000 went to the charity, only 30,000 of that is taxable. When we get to the bottom line, we get to adjusted gross income, we only have 30,000 included instead of 40, and we still get the full $30,000 standard deduction. Now that's a win-win, isn't it? Okay. So using qualified charitable donations, yeah, that's the beauty of it. There's two constraints when you're using it. One, as I said, it has to come directly out of the IRA account. Many of the companies that hold your IRAs will actually give you, if you request it, a checkbook on your IRA. Now, the reason the brokerages are willing to do that is because there is no responsibility on their part. The government doesn't give them any requirement to actually monitor what you do with the money. So any dollars coming out of that IRA, they're going to put on the 1099-R that shows the total distributions for years. The way that the government knows that it was a QCD is that you tell them when you prepare your 1040 that that portion of the money came directly from the account. The second requirement, besides coming out of the account, the second requirement to have a qualified charitable donation is that you get a receipt from the charity. Okay. IRS for a while was looking at about 20% of my clients who were using this technique. So many more people now are using this technique that I don't think it's hitting 20. Either that or they've gotten used to the way I put it into the returns, because when I put in the return, I also attach, here's the list of who we gave it to, okay? And that goes with the return so that at the time they decide to inquire about it, they've got all the information they need, except the confirmations from the charities. Okay. So make sure you get the confirmations. Don't file the return until you've got it. Even if you've are ready to file by, I'm going to tell you what has been traditionally the case, April 15th. instead of this crazy year, when here we are in November and we still haven't met the filing deadline because it's next week. Okay, so QCDs preferred for people who are over 70 and a half. Donor advised funds can be used for any age. Year-end bunching as an alternative to see if you can break through that threshold to beat the standard deduction. A reminder again that while I mentioned that charitable donations of cash are deductible up to 60%, capital gains property are limited to 30% of your AGI unless the donation goes to a semi-public or private charity, and then it's 20%. Those typically are called foundations. Okay, amounts in excess of the limits are carried to the next year and the next year. I have, I think, a handful of clients right now who got so excited about the ability to give funds away that they have exceeded the maximum they can deduct in the year. In other words, they've exceeded either the 30% of AGI or the 60%. But most of my clients give away appreciated assets, so we're looking at 30%. Now, what happens when I've done that? If you were to do a charitable donation in the year 2023 that exceeds 30% of your adjusted gross income, and it was appreciated securities that you gave away, then after we calculate the maximum that you can take on the 2023 return, we have 5 years going forward where we will be able to try again. And when I say try again, you have the return prepared, you reach back and said, do I have any left over? How much can I use this year? We look at the 30% of AGI limitation for that year, and we suck up and use as much as we can of that carryover. Now we can do this for 5 years. Okay? If you haven't used it up after those 5 years, it disappears. So that's a challenge you face. How do I use up all of my charitable contributions that are carried forward? But bottom line to be aware of this is that you don't lose it until the 5 years is up after the year that you make the charitable contribution. Okay. So plan your donations is the big part of it here. Okay. I mentioned donor advised funds and the standard deduction using that. QCDs, we talked about those. So I say think creatively, and think creatively with the qualified charitable donations is keeping your adjusted gross income low. You know, keeping your adjusted gross income low not only affects your income tax. For those people who are subject to the Medicare premium, oh my goodness, this is even more important because QCDs, using up that IRA, the QCD portion of it lowers your income, so it keeps your modified adjusted gross income lower and could affect your premiums you pay for Medicare. So let all of these factors go into your head. The donor advised funds, that's the one I used to say, go big or go home. So go big 1 year and itemize and draw down for a year or two, and then while you take the standard deduction. So think creatively in how these can help you. Let's see. I'm gonna do one more, still in the itemized deduction. No, what still works is year-end planning worthwhile. I'm going to take a break here, Lynn, and give us a chance to, let's see.
There are a large number of questions.
Yeah, that's what we're going to do is take questions. You want to go ahead and start with that, Lynn?
Okay.
Deborah, yeah, either one of you. Mm-hmm.
The $300 charitable contribution for non-itemizing filers still exist?
No, that was during the pandemic time frame.
I believe this is regarding state income tax. You commented on mortgage, but did not say anything about property taxes. It can be quite high for those who recently bought a residence.
That's right. And property taxes are fully deductible on the state returns too.
Our Medicare Part D and Medicare supplemental contribute to medical expenses. What about Part D copays, hearing aids, dental expenses, optical, including expenses for glasses?
All of those are medical expenses that can be itemized.
Brokers will not take a sell order for stocks under $1 per share. Is there a way to use a capital loss without actually selling the stock?
under $1 a share. It could be the not all brokers are the same on that, and maybe a phone call to your person that you work with at that brokerage, asking them to withdraw the stock to show that it's no longer, that it's worthless, essentially, because essentially what they're saying is the cost to sell it is greater than the money that would be generated from the transaction, apparently, right? And so I would talk to them about removing it if I wanted to take a capital loss on it.
If it's truly worthless, then most brokers will just take the stock.
Yeah,
Then you
that's,
get into the case of where maybe it's 50 cents a share and things get messy.
yeah. And so at 50 cents a share, is it going to generate anything left over after their commission? If it is, sell it and get your 36 cents and let them get their commission so that you can show that it's gone.
Can you please discuss QLAC annuities?
QLACs. Okay, qualified longevity annuity contract. That's what a QLOC is. Okay, so this came into the law a few years ago as people were starting to age, and we still had the 70 and a half as the date you had to start taking your distributions, as a way for people who were concerned about running out of money in their IRA. So the government at that point allowed, gee, it's a limited amount of funds to be set up. It's an annuity, qualified longevity annuity, an annuity that doesn't have to start having distributions until you reach age, I believe, age 85. Okay. And so you could postpone taking RMDs on the amount in the QLAC until you hit that triggering age. And this is from memory. So I'm thinking 85, it may not be 85. It might be slightly less than that. But essentially, it was to allow the delay in starting your RMDs. But they limited the amount of money that was in it. Okay. So when they limited the amount of money that was in it, it was okay, I'll do that with this piece. And your choice, because it's a annuity, is only as an annuity when you invest it. Although annuity brokers give you choices of how the annuity funds are invested many times. But it's a small portion of the portfolio. But if you have a concern and you would like to delay the RMDs on that small portion, then yes, go ahead and take advantage of it. I have one woman I can recall who did it, and let me see what her situation was that made it make sense for her. Single individual, okay. The IRA was going to go to charity at the end anyway. She didn't have a need for the funds, and she wanted to space out more what she had to take. Okay. For her situation, I thought it made sense. Another woman said, "My dad lived to be 102. I don't want to run out of money." Okay. Another reason why for that person, pulling a portion of their IRA funds and putting it into the QLAC made them feel more comfortable. That's fine. So those would be examples of where it might help.
There's a
Another
couple.
one. Mm-hmm.
There's a
Go ahead.
couple questions regarding donor advice funds. When the
Okay.
stock is moved from personal account to donor advice fund, is capital gain taxed at that point? Any gains when the stock is and the donor advice fund are taxed when sold or distributed? And also, I think,
Oh, okay. Let me go through that for you, because the transfer of the asset into the fund generates a charitable contribution for you. You didn't sell the stock. You get the value on the date you move the stock into it as a charitable contribution. When a charity sells a stock, does it pay any taxes at all on it? No, unless it's a private foundation. Okay. So there is no taxability on the gains on that stock. They disappear. However, if you sell the stock yourself and then want to make a charitable contribution with those funds, you're going to pay taxes first, aren't you? Because as soon as you sell it, you incur a capital gains tax. And then you have less of a pool of funds to work with to give to the charity. So donor advised funds cut out a lot of, they make it so tax efficient. It's really beautiful. Yeah, beautiful. I like charitable remainder trust too. I think, oh, those are beautiful too.
isn't it best to contribute long-term capital gains and
Oh,
not anything?
absolutely. Do not use short-term capital gains, because when you contribute, and here's one of my clients He was so proud of himself. He sat across from me and said, "You're going to be pleased for me this year because I finally did it." And I said, "Did what?" And he says, "I used stocks to make my contributions with." And he says, "I counted the days and I had held that stock. I bought it on March 1st. I sold it on March 1st. Did he have long term? No, because a long term gain is more than 1 year. He would have had to sell it March 2nd to have capital gains property. The reason that's important, capital gains property, I get to consider as a donation the fair market value of what I gave away. Short-term gains property, short-term gains property, I get to deduct my basis. Oh, boy, what a hit that is. Something that's gone up in value quickly and you're excited and you give it away and find out that you can't take a deduction for what it was worth. Then that's like shooting yourself in the foot. Okay. One other item that works this way, let's see. It went through my head as I was describing this, the where you can get yourself in a jam. Lost property, you never give away capital loss property. Yeah, whether it's short or long, you don't give away securities at a loss. Why? Because, I mean, you get to deduct the fair market value or your cost, whichever is lower. And the second part of it is use that loss. Oh my goodness, if you are going to do something with that security, take the loss, let it offset capital gains. You know, you said there were two questions with that.
That you answered both of them.
Okay.
Um, California taxation rules on QCDs, same as federal?
Ooh, you know what? California is so quirky, and I don't know if they followed that or not. Rationally, California will typically follow on things like retirement plans. It may take them a couple years to do it, but since the Tax Cuts and Jobs Act, California hasn't followed anything. So I would have to look that up on the QCDs about California. I'll give you a screwy one that I ran into just the other day. Was a family that used where we have a California federal difference, and this had to do with the education savings accounts. Okay. On the education savings accounts, the federal government allows us to use up to $10,000 a year of the 529 plan to pay for private school, not college, meaning private elementary school, private high school. Okay. And that's kind of neat because you get that account going early. The child ends up going to private school. You're able to reach it into $10,000 a year and use that to help pay for part of the private school before the kid even hits college. Okay. And that's great for federal, but that's not how it works for California. California, for one thing, it doesn't never followed that change in the law. Okay. So for California, they do not permit a donation, not a taking of any funds out of a 529 plan for purposes of playing an elementary school. The client's daughter was going to a private high school. They dipped in, took the $10,000, were fine on the federal. For California, the component of that $10,000 that is made up from the years of earning, in that case, it was about $3,000 worth of earnings as the proportion that was applied to that 10,000. That $3,000 was taxable to California, but it doesn't stop there. California has a penalty for making an early distribution or a non-qualified distribution from one of those plans. And I double checked this and looked it up over and over again. And I said, this isn't fair. This isn't right. But the people got to pay taxes on both the $3,000 of earnings plus a 2.5% penalty for doing it in the first place. So California federal changes, you got to watch them because they just don't match. In fact, California has expanded the California CA federal. It's the form that has the federal and California differences in it. And they've expanded it now to 5 pages. And if you go to the publication they publish annually that talks about California federal differences, you're going to find that small book is so many pages that, yeah, that it'll put you to sleep. But there's so many pages to it because there's so many changes that are different. California is a unique state. So
Okay, a couple more questions. I pay Medicare premium, but my pension reimburses it. Can I deduct the premium? Is the reimbursement considered taxable income?
your reimbursement is a reimbursement of what you paid. You're not going to deduct it because why would you want to? I mean, you can't, because essentially you didn't pay it. Um, it's so just stop at that point. Okay, stop at that point. I was reimbursed for it. I'm not going to take it. What was going through my head is occasionally reimbursements take a while. And what happens when you have a medical expense that is very large and you want to cram it all into 1 year and you haven't been reimbursed for it? Okay, so this year you take it as an itemized deduction. The next year, the reimbursement shows up. What happens then? Okay, it's considered taxable income, but it falls under the tax benefit rule. Tax benefit rule says, how much of that reimbursement did I actually benefit from? Okay. The part of it that was a reimbursement that netted to zero, and with medical, there's always going to be a portion that's going to net to zero because we have that threshold we have to get past. But only the part that is excess that I actually got a savings from. What caused me to get that savings was that medical that I deducted the last year when I ended up getting it back the very following year. So it becomes income to the extent that you got a tax benefit for it. I know we're getting close to that time you take a short break. Are there
We
any
can,
other questions or shall we?
there's a couple more questions.
Okay, let's do
Can you
those
make
and
a
then.
QCD before starting RMDs from your traditional IRA? I'll be 70 and a half December 30th, 2023. Can I make a QCD for 2023?
When you say make a QCD, essentially what you're doing with a qualified QCD, qualified. Oh,
Charitable
charitable donation.
deduction.
Okay. Let me go back. I was thinking QLAC because of the Q in there. Okay. 70 and a half is the threshold. When you hit 70 and a half, you can make the charitable contribution. So you should wait till that part of the year and then make the QCD from the IRA
He's
funds.
cutting it close in that he reaches 70 and a half on December 30th. Is he
Oh
still?
dear. Here's what I've seen clients have problems with over the years with the QCDs. I encourage my clients to always get the QCDs out by the end of November, which is coming up, 3 more weeks here. Why? Because if the company that you gave the charitable contribution to does not cash that before December 31st, then it doesn't count for that year. And every year I hear a sad story about, well, I don't know one woman, Red Cross, she sent them duplicate checks because they didn't cash one and they still never cashed the thing. She said she won't do QCDs with Red Cross anymore. Okay. Another woman made the QCD payable to Stanford. It went to Stanford and somehow it went to, well, she had written it such that it went to Stanford Hospital. It got over to accounts receivable at Stanford Hospital. And what they did with it was keep searching, trying to figure out if the person who sent it actually had a balance due to the hospital. Okay. And they didn't, so they eventually sent the check back to her, which meant that she hadn't met her required minimum distribution for the year. Okay. So lots of screwy things can happen. So I suggest that if you're going to make QCDs, do them by the end of November to allow enough time for that charity to cash the check. And reminder, you've got to get that thank you letter from them. So you may want either, if your financial planner is dispersing it, there was a situation I talked to someone about yesterday, the financial planner was dispersing it. They sent a letter with the check saying this is being made from the IRA of this particular taxpayer. Please confirm receipt. And she said they have much better luck getting the documents they need when they've done it that way. So I hadn't heard of someone actually sending it quite like that. But QCDs, they're a good idea, but you've got some quirks that can happen that can rob you of the benefit of them.
Isn't the limit 100,000 a year, or is it a total of 100,000?
It's 100,000 per year per taxpayer. Husband and wife both have huge IRAs. Now, I haven't seen this happen. I have seen people reach the 100,000 and keep going, but each spouse is entitled to 100,000 out of their IRA on an annual basis. Okay. And what
Okay.
happens when it exceeds 100,000 from one taxpayer? The excess amount is counted as income, and the part that went to charity goes to your Schedule A and becomes a charitable donation there. So you don't lose it completely, but you know.
Okay. The next is just a statement that you can't fund a DAF from a QCD.
That's true. A donor advised fund, you cannot move money from a IRA as a qualified charitable donation, doesn't count. Yep.
Okay, the next one you haven't specifically covered. We have a CalAble 529 account
Okay.
for a disabled adult child. Can we move
Yes.
the ABLE account to another state if we move out of California? Can we have multiple ABLE accounts? And an adjoining question is, what do you do with unused 529 funds?
Oh, okay. So that's a multiple question, and there's news on both of those things. So I'm going to first start with the ABLE account. The CalAble account came into law. The federal side of it came in first, and California has a CalAble. So our state is comparable to federal on this issue. If you were going to move to another state and have the account moved, I'm not sure it's totally like an IRA, with IRAs or with 529 plans. With 529 plans, once a year, I can change that to a different state. But no matter what state it is in, the distributions are treated the same. Okay. On the CalAble account, I think before I tinkered with it, I would want to understand what the parameters are in the state that I was thinking of moving it to. Meaning, if you've got a good plan in one location, why change it just because you've moved? Okay. The CalAble accounts were put into law to assist people instead of a special needs trust, and to provide that extra flexibility, that extra source of funds to help people that are disabled. And it was in lieu of a person who, the qualified disability trusts are great, but they usually take a much larger amount of momentum to get them started. Okay, and often a lot of them are left as bequeaths in a trust to a disabled child. But the ABLE account can be funded on an annual basis and can accumulate, uh, and it's for people who have lesser means but want to make sure that that child has some ability to get some benefits after they're gone. The second question you asked had to do with, what was it? The question was on
What
529.
happens to unused 529
And the
fund?
reason that's a good question is the 529 plan doesn't require a date that it has to be distributed. Okay? Meaning, for example, right now, my granddaughter is in college. She's starting to tap into her 529 plan. If she goes, but she was also a scholarship recipient. And as long as she can keep playing water polo, then she will be able to have a less expensive college than was anticipated when we funded the 529 plan for her. Okay. So if she graduates and gets her bachelor's degree and there's still some money left in that 529 plan, she can use it to pay for graduate school. If she doesn't spend it all, there's no date that it has to be spent by. She can give it to one of her siblings. She can say, gee, my sister is not an athlete and she's going to be the doctor, so let's give her the funds. So she can give it to a family member. Okay. She can take, say, because this is a new one, I believe it was to take a certain dollar amount that tied with, because this is recent legislation where you take some of the money and put it into I think it's a Roth IRA. Ooh, I may have something on it a little bit later, but there has been a recent change that allowed, and it's not a large amount of money, but it's a one-time amount of money that can be put into a retirement account for the person too. So Laws change all the time on these, but don't feel like you're stuck and you're going to have to pay a penalty because you have to pull it out. You don't have to pull it out. If you do take it out, then and it's not spent on education, you will pay a penalty on the earnings on it. So that's why the ability to leave it there, take graduate studies later, take it and convert it to a family member's, wait till you have a child and make it your child's 529 plan. I would look at those choices first.
And there's
Okay, let's, oh, you have a last one and then we'll take a break?
one more question came in. Some states have better plans than California.
Yes, that's true. Saving for College is a website and they do saving for college. Okay. And you can go to that website and they do an analysis each year and show you the returns by states. Okay. Because each state selects one carrier to hold their money. Okay. And to invest their money. And some of the mutual funds that you're very familiar with have been adopted by specific states. Okay. And even the brokerages that advertise, yes, we offer a 529 plan, have adopted a specific state to use their 529 plan because that's how they were set up in the first place. So you can change from year to year. You can keep track of the returns that are being generated in these funds. I always look and say, is the plan that I'm in, does it fit in the top 5 for the last 10 years, 5 years, 3 years, and compare it in there and see if it's getting a reasonable return based on what the averages seem to be overall. But it's a good resource to find out and compare the plan you have and how the return has been versus those. And each of the different states offer different choices in terms of what category, meaning if you're starting with a child that's 18 months old and making a donation, you've got a long time before they're going to use it. And so the category of things that they would invest in may carry more risk because they have a longer timeline. But if the person who you've got the 529 plan for is already 18 years old, it's like, how long is it going to stay in there? Okay. So the choices of how it's invested inside there could be very restrictive in terms of keeping it only in money market. So look at the choices. Yep.
Yeah, there's a partial, I only got part of the last question. How can we pay for college tuition with CalAble plan if they only provide a debit card to use the money and the college won't accept the debit cards?
You said pay for college with CalAble?
Yeah.
No, because you wouldn't be paying for college with that. And you're saying that some 529 plans provide a debit
This
card?
said specifically CalAble had a debit card only, and they're trying to pay for college tuition.
I think we've got some inconsistencies there, so I don't understand the question.
CalAble can be used for education, rent, food, but
yeah, it's a variety of things that it can be used for. It isn't restricted like a 529 plan would be.
Okay,
let's go to our break then.
All right, it's 10:25. We'll restart at 10:35. During the break, I'm going to put up a poll regarding a possible in-person meeting in May. So if you would please, during the break, answer those questions, I would appreciate it. And we'll restart at 10:35.
Welcome back to our main event for November. Claudia will continue with the rest of her material on taxes and focus on efficient retirement use of IRAs. Go ahead, Claudia.
Okay, just before the break, we took a lot of good questions. And with that, I'm going to move into the next phase of our presentation. I'm going to talk to you first about, as we do year-end planning, there's certain things that we need to have clear in our heads of how things work, because we hear the phrases, do some harvesting of losses, those kind of things. Let's make sure we understand the nature of capital gains and capital losses. So, first of all, if we have a tax return, think of it as the Schedule D. Look at the Schedule D, and do we have net short-term gains and short-term losses? We net those. Anything that's short-term gets netted. Then we turn to long-term, and we net long-term gains and losses. It's only after we do that that we net short-term against long-term. If, after going through each of those 3 steps, we still have a loss, we can deduct up to $3,000 of that excess loss against ordinary income during the year. This $3,000 has been the same maximum level for 30, 40 years at least. Yeah, so some things just don't change in taxes, unfortunately. But anything in excess of that 3,000 loss is carried over to future years, but it retains its character. Okay. So a short-term loss retains short-term character. Long-term loss retains a long-term character, so that the next year when we carry them forward, we start the process again and we net that short-term carryover loss with our short-term gains, long-term loss with the long-term gains. Okay. That's an important benefit. Why? Because short-term losses offset income that would be taxed at the normal rates, and long-term losses first offset gain that would be taxed at a reduced rate. So there's a sequence, a benefit of being able to keep all of these things clear in our heads as we go forward them. Okay. So know the rules and know that it's netted. I was on vacation at one year around the holidays, and one of my clients called the office and said, "Is it true that I can take a $3,000 capital loss?" And whoever answered the phone said, "Yes." And that's where the conversation ended. Okay. So when I was preparing the return for that gentleman a few months later, I said, "Whoa, you sure had a good year. It's too bad you didn't have a few more losses." And he goes, "What do you mean had a few more losses?" He's like, "I called your office. They said I could take 3,000. So that's a net 3,000 after the whole picture. It's not only a loss of $3,000. Yeah. So know and understand the rules as you go through them. Now, one more piece where I saw a person get into a bad spot last year. Okay. When executing transactions intended to affect your tax bill, the trade date, not the settlement date, determines the holding period for most transactions, but it can create wash sales. Okay. Here's what happened to the person. They sold Tesla on December 2nd of 22. It settled on the 6th. Okay. The normal rule, right? You got paid your shares on December 6th at settlement. On this date, you no longer owned the shares, period. You bought Tesla on January 3. You see how close he's catching that? He waited the 30 days. He didn't want to create a wash sale. Okay? You bought Tesla on January 3, but it settled on January 5. You paid for your new shares on January 5 at settlement. On this date, you owned the shares. The difference between actual ownership or settlement days of December 6th and January 5 is 30 days, not 31 days. Remember we said earlier, more than 30 days? Yeah, 30. So you can imagine this is a significant transaction on this tax return. And when I reviewed it, I said, this one looks off. I said, why are we getting all of these pullbacks? Why are we getting all of these disqualified transactions? Because you executed them so closely on here. And he said, I was counting the days, okay, but he wasn't counting them from the correct days. And because of that, we lost out on a huge loss that was intended to offset a very large capital gain too. So be careful with timing those year-end transactions, count the days, look at settlement, not execution on some of these things. Yeah. Another one, I see clients who get contacted and what's being promoted is tax loss harvesting. Oh my goodness, get in there and harvest those losses. And there are some firms that will offer to do it for you. Okay. One of my clients opened up a new account because the people pushing it said, well, move your money over here and we will monitor it and take care of tax loss harvesting for you. Capital loss harvesting may be used to reduce taxes on other reportable capital gains, which makes it sound like a good idea. And it requires selling securities at a value less than their adjusted cost basis to create the loss, which is generally used to offset other recognized capital gains. Still a good idea. With the potential for volatility in the market, harvesting losses should not be limited to the end of the year. Now, that's something to consider because a lot of times people don't think about this until the end of the year, where maybe they should be harvesting those losses throughout the year at different points in time when they realize that the reason they're holding that stock no longer is a good reason to be holding it. I mean, that's a unusual way to say it. But let me explain to you on this one a step further about why this became a big problem for the client. Okay. The client in this case was so excited about this that his largest portfolio happened to be in a trust that held the funds from his deceased wife. It was a bypass trust. Remember when I commented about trusts and how they have income and they have corpus, and the corpus stays in the trust, the income can be distributed. And that was the case. So he went into this account, gave the people the discretionary to harvest loss, and my goodness, they were very successful. They harvested above $80,000 in losses in a reasonably short period of time. Wow. Unfortunately, what happens inside a trust is not the same outcome that he would have had he done this in his personal 1040 account. Inside a trust, capital gains and losses stay inside that trust. So at the end of the calculation of what the tax liability was for the year, the maximum that could be used of that loss was $3,000, and the excess over that amount simply stayed there, didn't do him any good because it could not pass out to him personally. It had to stay inside the entity. So he lost out on it. So understand the entity that you're doing your investments in, understand the netting, and use the tool, but use it judiciously. Don't let someone come in and tell you and say, have I got a deal for you? Join with my firm and we will do loss harvesting for you. Is it really in everyone's best interest? Now, the last, here's a good one. This is one, the issue, there was one question that came up during the question and answer break, but I want to be specific to it. Secure a loss deduction for nearly worthless securities. You can deduct the loss on worthless securities only if you can prove the investment is completely worthless. It doesn't count if you still own the security and it has any value at all. And almost every year someone comes up with this question. Well, it's not worth hardly anything. Yeah, operative word, hardly anything. It's a go, no go in terms of it. Is it worthless? Is it worthless? There is no market, or as the question that we dealt with earlier said, well, it may be worth $15, but the brokerage doesn't want to do it because they normally charge 18 for this kind of a transaction or something. Yeah, talk to the brokerage and ask them to remove it from your account. Yeah. If it's private securities, I have seen people who take advantage of this can tender the investment back to the company in the first place, meaning in a partnership, for example, and you're trying to get out of it, you tender your interest back to them. I've seen other ones where someone that's also a partner will say, look, I'll pay you $10 for it. And they will take the interest over it. They can continue, you get your loss. But they also enjoy the upside if there is any upside on that. Okay, let's see. So I think we've talked about each of these ideas for year-end planning, the bunching the deductions, the RMDs, the QCDs, the loss harvesting. One thing I want to mention on Roth conversions. A lot of people, and we're going to talk more about those, and we're going to give some examples of is it really in your best interest next. But on the Roth conversions, a couple years ago, before the Secure Act 2.0 version, we were able to do a Roth conversion Wait until we prepared your taxes and say, okay, let's optimize this, put this much money back in the Roth. Or ask the person, now here's how much money you're really going to have to pay on this. Do you want to change your mind and put it back? Okay. Yeah, that's not a choice anymore. You do the Roth conversion, you live with what the results of that loss conversion are on your tax liability. So to me, it means you have to be a little bit more careful in your calculations of willingness to pay. Clients ask me the question, should I do a Roth conversion? And I usually say, as much as you want to pay tax, how much shall I convert? As much as you want to pay taxes on. What do you mean? Well, if you convert it, you're going to recognize the income at the time that you convert it from the regular IRA to the Roth. And that means you paying the taxes now. Okay, so that's what, that becomes a little stickier. So no more do-overs with the Roth conversions. You do it, you're stuck with it. And the last tax planning thing is relocating to a tax-friendly state. And we have ones around us, but most of us who've been here for a long time, I'm going to say we enjoy the weather, but it's been so crazy this year. I guess it's still enjoy it better than what the alternative might have been. So we're going to move now to a quick discussion of retirement issues and how things have changed in the last couple of years. Okay. In late 2022, Congress passed legislation that raised the age you have to start taking RMDs from 72 to 73. And just shortly before that, 2020, they raised the age from 70 and a half to 72. So what this means is that if you turn 72 in 2022, you'll need to take your first RMD by April of 23, and we'll need to make another one by the end of 23. Now, why would that be? Okay, this is similar to the rules in terms of first year that we've had for several years. I'm going to go into that in just a second. If you turn 72 and 23, you won't have to take an RMD until 24 when you turn 23, which means the first one will be due by April 1st of 25. Well, first of all, I look at this and say, wait a second, they raised it by a year, but for a lot of people, they're already going to be committed to the track of having to take it. So why are they raising the RMD age? They're raising the RMD age because at some point in the back of someone's head, sitting near the Potomac on the other side of the country, is the thought of raising the age that you'll qualify for Social Security. Okay? And because they're saying, well, gee whiz, we're doing you a favor because people are living longer. And that's the part that scares them with the Social Security part of it. So the people that will really affect are those who reach age 74 after December 31, 32. Well, I'm not going to say really affect because in this piece of legislation, after tinkering with this 2 years in a row, they've already set in the date that it'll reach age 74 and then go to 75. Okay. For those who reach age 74 after 2032, okay, the RMD age would go to 75. So with those pieces in the back of our head, we know that there's some timing that's going on that's going to make a difference. Another consideration when it comes to this, and I'm going to ask the question, then we're going to talk about some pros and cons here. Okay. Does making Roth IRA conversion still make sense? And I put, for some taxpayers, it does. It depends on the age. It depends on how much basis you have, so that when I say basis in an IRA, if you have been making non-deductible IRAs for many, many years, each year that you made a non-deductible IRA, you have a basis. In the year that you do a Roth conversion, you look at the total amount in your IRA account, okay? And I'm going to assume for a moment that you only have one account because you do have to like take all of the IRAs that you have and put them together and look at them to do this. It isn't I can put my ones that were non-deductible in one account and the ones that were deductible in another. It doesn't work that way. You aggregate the IRA accounts to make this calculation. So does making a Roth conversion still make sense? For some taxpayers it does, but you really need to calculate what's the hit going to be for me to do this. and you look at it in terms of your age and how it's going to affect everything. I mean, for many of us, if we did a major Roth contribution at this point, can you see what our Medicare premiums would be for the 2 years from now? Oh my goodness, they would be jumping up into that top, potentially into one of the top premium things. So that too should be considered about what are the costs of my doing this. So first of all, is there a way that I personally can affect that? Well, if I'm still working and I have a rollover IRA and I have my contributory IRA, I could look at reducing my total IRA dollars by taking the money that was my rollover IRA and seeing if my current employer would let me roll it into my pension plan at work. Doing that, it's still mine. It's still my vested portion of that money. It's just being managed in a different way, in a different type of account. And because that 401k is no longer, that rollover IRA is no longer a rollover IRA, it's now a 401k, it doesn't go into my calculations of total IRA value, which then gets me closer to the original money I put in my Roth, my IRA in the first place that has basis. And so any conversion at that point will have a larger portion that will not be taxable because I will be recovering my basis when I convert to a Roth. Okay. Yeah. So making the Roth conversion still makes sense. Spend the time to figure out how much you're going to pay taxes on if you make that Roth conversion, how many years you're most likely to benefit from it. But I'm going to give you another example of when I don't think it makes sense. I've got a few clients who never had children. Okay. They don't have the same kind of thought process we do about, gee, when I'm gone, I'm going to leave all of my assets to my kids. Okay. And wouldn't it be nice if the assets I could leave to the grandkids were my Roth IRA? And I had gone through this process myself before they shortened the time period to 10 years. But then now I'm saying, I sure hope my kids are teaching their kids to manage money well, because there's a good chance that the kids will come into my IRA and be stuck with this 10-year period they have to take the money out. But for people who don't have children and grandchildren they're worried about, who have already made the decision that at the end of their life, if there's anything left over in that IRA, it's going to go to charity, why would you do a Roth conversion? Okay. I mean, if I did it, I could pay all the taxes at once, but if I give the money to a charity when I pass away, that charity is not going to pay any taxes. Why would I want to pay the taxes for them? Okay. So think through how it would affect you down at the end of the road before you just jump on the bandwagon of I've got to do a Roth conversion. None of us want to pay taxes that could have been avoided, and doing a Roth conversion when the charity is going to get the money is taxes that could have been avoided. Another thing to look at. Every year when I have to take my RMD, I look at my tax picture for the year and make sure I've paid in enough estimated taxes. Because one of the best resources, the best place to pull money from to send in as an estimated tax is withholding from my IRA distribution. I asked Fidelity last year, is there a limit on how much I can give to the federal government from this account? And he says, we will give them whatever you tell us to give them when you do your distribution. So bottom line is, between California and federal, after I've done my QCDs, all of it went to either IRS or franchise tax board because of other situations in my tax picture for last year. That didn't make me feel good, but it eliminated a potential for an underpayment of estimated tax penalty. Because when IRS receives money through withholding, they don't track the day they did it. So I could do this at the end of November where I have a fairly good look back of what the year is going to look like and know what the liability is going to be close to for making those payments to get them in. And it, because there is no timing associated with underpayment of estimated tax, withholding, then I avoided the potential of that. Um, when you send in an estimated tax voucher, the government knows when they get it, and they look for the dates April, they look for June, they look for September. If you're in federal in California, you can avoid a September and then just go for the January. Okay. So consider using them for estimated tax purposes when you need it. Okay. And another resource I wanted to point out to you is if you're looking for help with retirement issues. I believe that the IRS has some fairly good information that they try to keep current. You always look on the form and find out the last time it was updated. But these three in particular that I felt were worthwhile, you can key in the words that I have in the URLs on these. But the first one is employee retirement topics early on early distributions. Okay, so the first one talks about if you take money out early, the exceptions to the penalties. And nowadays there are so many exceptions to the penalties. I mean, there can be exceptions for certain maximums. For example, taking money out to buy your first home, that's up to 10,000 per person is an exception to an early distribution. Medical expenses, paying for medical insurance when you're between jobs. There's lots of different exceptions. Every year they add a few more, but being aware of those when you're put in that situation where you do have to pull money. There's a FAQ on withdrawal distributions and the rules about taxability of them, as well as required minimum distribution FAQs. So I put this on there as just a reminder. Those don't cost you anything, and they're a fairly reliable source. And when I say that, they are not considered when you get something from an IRS pub that you relied on, it's likely to get you out of penalties if you can show that you relied on it to your detriment. And sometimes you can because they aren't totally accurate. Ooh, I shouldn't have even opened that box to tell you that. But at least it gives you something to hang your hat on for why you took positions on your return at the basic level. Okay, here's another biggie that happened in this last year. And that thing that happened was, as I indicated, the government tweaked the distribution chart that we use each year where we go to it, look it up, say, here's how old we are, here's how much has to come out. And the chart I have on the screen can be used for normal situations. You would not use this chart if your spouse is more than 10 years age difference, okay? And there's some other situations where this chart doesn't get referred to year over year. It gets referred to in the year of death for the person that you inherited it from, and you count backwards from there. But the chart basically answered the question that people had complained about on, I'm afraid I'm going to run out of money. Yeah, I'm afraid I'm going to run out of money. So the government redid this chart, and you can see that at age 72, you divide the total amount that's in the IRAs by 27.4. Now, heads up on this one. When you make this calculation, you can either, if you have 3 IRAs, divide the amount in 3 IRAs, or you can get the total amount and divide that by 27.4. You do not have to take a distribution from all 3 of those accounts. So the number is going to come out the same whether you do it 3 times or 1 time, and you know the dollar amount that must be distributed. So here's a thought on that. I really believe it's helpful as you age to try to reduce the number of accounts you have. If you have 3 IRAs, looking at that you have to take an RMD from one of them at least, and you know the dollar amount of it, you might want to look at it and say, I'm going to start chipping away at the first one here until I use it all up, and then I'll be down to 2 accounts, and then I'll be down to 3. You might want to merge them together. Think about not only your own management style as you age on these proliferation of accounts sometimes that we go through life and pick up one here, one there. Think about if someone had to step into your shoes and take care of this for you, or, oh my goodness, try to find things. I mean, I'm working with a family, and we are now 3 years after their dad died, but their mother has had Alzheimer's for this entire period. and they are still trying to find all the pieces. And I talked yesterday for about a half hour with the client saying, these are accounts that existed 6 years ago. Okay. Have you been able to find them yet? Have you heard from them? Why aren't we receiving information? So simplifying your life is helpful. But if you have the one total amount, you don't have to take it all three. Here's a caveat. Here's something that I would worry about and you need to be aware of. If you have multiple accounts, each of those companies may treat not hearing from you differently. For example, one of my clients had two reasonably comfortable size IRA accounts. He decided that one year, year before last, he was going to take the full amount from one account, which he proceeded to do. He didn't communicate with the second account. And what they did is they got close to middle of December and said, oh my goodness, he hasn't taken an RMD. There's a significant penalty if he doesn't take it. They cut a check and sent it to him. He took a holiday over Christmas and most of January. And when he came back and going through the mail, he found the check and he said, I don't want this money. Okay. But unfortunately, by the time he started doing his tax stuff and realized he didn't want that money, he had passed the 60 days. And there's a 60-day rollover period that he could have taken that and just put it back in the other IRA account and avoided taxes on it. And probably if he had known it had happened or corresponded with them, I mean, as soon as they issued it, they may have let him give it back because it was so close to time and it was still in the same calendar year. So if you have multiple accounts, your distribution comes from each one. If you have an IRA and a 401k and a qualified plan, all of those plans have to have their own RMD. So you take the calculations by type of plan. Multiple accounts in one type of plan, you can choose which of the plans you take it out of. But otherwise, be careful that you follow the rules and watch out for ones that are on autopilot and you don't know it. Okay. So as we see here, a person who's 72, just starting their journey through RMDs, or 74, the 25.5 years. Okay. Looking at this, if you will notice, you don't lose a year every single year. I mean, 27.4 drops to 26.5 and then drops to 25.5, which is a full year, but 24.6 isn't a full year. So what is this doing is it stretches out. It doesn't mean that if you're 72 and live 27.4 years, you're going to be out of money because you've used it all up. Because if we go on to the other end of this chart, you'll see that you can live to be 120 and still be taking out a lower amount in your account. And it would have been it would have been 90 something if we just took it out a flat amount every year. The government did this because people were complaining about I was going to use it up, and right now I haven't heard of anybody hitting 120 with the IRA still out there, but they're likely to do this again. But it says once you hit 120, it's 2% per year. Okay, so they never force you to take and empty the entire account, which would be some consolation to people. Okay. But keep in mind that it's your personal responsibility, yours, not the brokerage, not the bank, to ensure that you take the full RMD by the deadline. So the first time you take that RMD, you'll have until April 1st of the year following. But when I'm helping clients with this decision, keep in mind that if I delay to April 1st of the next year, I'm going to have two distributions for that year because I don't get another delay in the second year. So you'll end up with two of them in the following year. And after that, you generally have till December 31st, the current year, to take that current year's RMD. And if you haven't withdrawn the full amount from the RMD by the deadline, the way the law reads previously was that there would be a 50% penalty. And I can assure you, none of my clients have ever paid a 50% penalty, because when I became aware that they had a problem with not taking the money, we always requested a waiver. And we would correct the problem before we requested the waiver. But with the latest Tax Act, we now have a scheme where that 50% has dropped to, all of 25. So maybe IRS does think that someday they're going to start enforcing this one, that it's now 25, and it can decline to 10% if the RMD is corrected in a timely manner. In such cases, you file the Form 5329. It's the last portion on the last page, I think. And on Part 9 of this form, the section talks about additional tax on excess contributions and failure to take you don't say failure to take distributions, but essentially what you're doing is you're allowing money to stay inside there and accumulate, and they don't want you to do that. So correct the problem, ask for a waiver. Even under this new scheme of things, I would correct the problem and ask for a waiver so that I don't have to pay a penalty on that. Let's see. And then I want to give you a reminder of how many types of accounts have this RMD requirement. Okay, so wow, workplace accounts. Now, workplace accounts in many cases don't have to start if you're still fully employed, but a person who's an owner of a company doesn't get that choice. If they own more than, I think it's 30% of the company, they don't get the choice of delaying. So they get to take it anyway. So we have all the IRAs, including the simple, inherited Roths. Yeah, inherited Roths, unlike the Roths for while we're alive, and we don't have to take a distribution. You inherit it, you still come under the same rules. And those new rules are the ones that tell us we have a 10-year period. And for the last 3 years, it's been delayed for the 10 years. So now we have 7 years left for those people who would have come under that rule in the first year of the law. Okay, so what I have on the screen now is just to let you know that there are also some reasonably reliable calculators online. I used this one at Schwab to show you how it works. You can go into it, anybody can use it. It doesn't have to be only Schwab people who have an account at Schwab. Okay, but for example, on this one, I was using the calculator to say, what is my required distribution? And we looked at the date of birth of January 1st, 1950, with 1.2 million in the account. Spouse not the beneficiary. The RMD is 45,000 the first year, and then it'll give you details on how it's calculated. So as a tool, as a quick way of getting it, instead of doing the hand math and trying to find the latest charts, you can go to the websites to find it. Okay. And one of the things that I thought neat about this website was, okay, what's it going to look like over the next 10 years? So I thought this was a good illustration because I said, with a 10-year projection of these values at this time, and that the fund itself is still earning a rate of return of 6%, what are my RMDs likely to be like? So I thought this was intriguing to see the years 2023 through, let's look at 2027. 5 years later, the RMD is up to 56,000, but the amount in the account that started out with 1,200,000 when we had to start doing that first calculation is now up to 1,320,000 because the portion I have to take out is less than the earnings each year. So I thought that was intriguing to get to see there. And again, available to you by using the websites for these companies. Fidelity is another one that I place in the reliable resource things because in their withdrawal from IRA, they gave multiple choices about when it comes to withdrawing money. Are you over 59 and a half, under 59 and a half, age 73 or older, and is it an inherited IRA? And in each case, you go through a decision tree, yes, no answers to work up to the correct approach for you with getting the answers. So take advantage of the ones that through your own experience you deem to be reliable on those. But tax laws change every year. And the frustration point is that they do change every year. And because of that, we have to keep an ear out to what things could affect us. And even though a legislation piece may come out in 1 year, like the Secure 2.0, then the government tweaking with it again the following year, it's my goodness, Congress is tweaking with it, but the people who write the rules, the regulation writers, the people in the Department of Treasury who are charged with interpreting those rules and making the information available to you and saying, here's how we plan to enforce it, uh, they haven't been able to keep up with the quick changes that get made from year to year sometimes. And that's why the government says we will give you a delay in enforcing things. And the Secure Act has been delayed now for 3 years, but eventually it'll be top of the heap again. One piece of legislation that came into effect several years ago, in fact, 2017 it passed and became effective in 18, has to do with the estate tax. I'm going to do a very brief comment on this to tell you what's happening over the next year or so, so you can consider whether any of this gives you reason to take some actions. So here's what's happening with the estate tax and why you need to know it. Tax Cuts and Jobs Act gave us today's rate formula in terms of how much we can pass of wealth from ourselves to a beneficiary at the time we die. Okay. Back in 2017, the government was able to collect estate taxes at this flat rate of 40%. That 40% rate hasn't changed. But what has changed is how big the estate is before it triggers having to pay these taxes. So starting in 2018, Congress raised that 5,490,000 to 11,180,000. That eliminated a whole lot of people from having to pay an estate tax. I mean, look at that. Those of us in this valley with the outrageous prices we have for houses and stuff, back in 2017, an IRA, a qualified plan, a small portfolio, and the value of our house could pop us to the 5 million. But when it went to 11, a lot of us breathed a sigh of relief and said, okay, good, I don't have to think about estate taxes. But unfortunately, that jump back in 18 is going to expire, and it's set to revert back to, I'm going to say somewhere between the 5.5 and 7 million. The reason I'm saying that is that it depends on what the inflation has been during that whole piece. Because the act that put it in place at these levels itself is expected to sunset. 2025 will be the last year that these rates are subject to the law that passed back in 2017. And so in 2026, we don't know what that exclusion amount is going to be, and everyone's guessing. Okay? Now, if you think about how legislation becomes law, you realize that it depends on who the laws start in the House of Representatives, which has been just slightly dysfunctional lately. Okay? But the laws start in the House of Representatives, and they come up with a tax provision and move from there. Well, I'm going to have good thoughts that they become more functional as they work through their problems and hopefully will address this. But if they don't, it could mean that a lot of people who live in houses they've been in for 30 and 40 years, by the time we function the value of the house on top of their other assets, could be back to paying estate taxes again in a few years. Now, is there anything you can do about it? Well, between now and the time this law changes, you can give away portions of your net worth, okay, to whoever you want it to go to at the time that you pass away, but you can give it to them now and use up these exemption amounts. The gift return system and the estate return system are linked together. So in addition to saying this is the estate tax exclusion, this is the combined exclusion of all the gifts that were taxable gifts. A taxable gift is a gift that in the calendar year you made that gift, the gift was valued more than the exclusion. I think last year we had 16,000 of exclusion available on a gift. So if I give a gift for $15,000, it doesn't get counted against my lifetime maximum. If I give a gift of 26,000, the first 16 doesn't count, the 10,000 over that counts and reduces my exemption, my lifetime exemption. So if at this point, prior to, if you believe that you could be subject to these rules and have that 5.7 million be more than you ever wanted to pay, then you could look at making a large gift before we get to these drop back rules, and that large gift would qualify. At this point, Congress has said, as soon as that law passes, there is no intention of clawing back and saying, aha, you already gave away 11,700,000. So now that the rate is 7 million, you owe us taxes on this. They haven't said that that's would be anything that they would consider on those. So be aware that this cliff is going to drop off, and think to yourself about whether or not you want to make gifts prior to that in such a way that it would be assured that you would get the higher values for your exclusions. Now, the next thought to put in your head is if you've had a spouse die in the last 5 years, okay, then the amount that they didn't use of their allowable exclusion. So let me put this back up here. If your spouse passed away in the year 2020, okay, and their half of your community assets was, what's easy to do with an 11? $5 million. If their half of the assets were $5 million, then they didn't use up the full 11,580. There was 6,580,000 unused of the exemption amount. A person who has this situation, the surviving spouse can say, hey, I'll take that extra 6,580,000. It's of my deceased spouse unused exemption amount. I want to claim that. And when I die, whatever the estate exemption is, I want to add that extra 6,580,000 on top of whatever the exemption is that year. That's called claim portability. That's called the ability to port, to take from your deceased spouse the unused exemption amount. That's what deceased spouse unused exemption amount election is all about. It's taking that and saying, I don't know what it's going to be when I die, but I'm going to take the part he didn't use and put it on top of whatever I get at that point. Because it may very well be what keeps you from paying estate taxes if we have a big drop back to that 5 to 7 million dollar amount. Now, when Congress passed this, they originally said you got to file an estate tax return to claim it. And they still, because that's was part of the provision, you file an estate tax return, a 706, to claim it. And initially, the thought was it had to be claimed on a timely filed one. But IRS Treasury Office, who administers this stuff, got so many letters saying, well, we didn't have a chance to get it done at that point. So they allowed what they called a delayed period to do the election to make this request. And most recently, that delayed period is 5 years. So if your spouse has passed away in the last 5 years and you didn't make this election, I'd suggest that you rethink whether or not it's time to go back and do it before the 5 years expires so that you can claim that portability. I mean, 2025 will be on us very, very soon. Okay. And with that said, we have reached the end of our presentation. I will give, let's see, till 11:30. I will go ahead and take questions if you have them, and turn it back to Lynn at that point.
There's quite a few questions pending.
Okay, so why don't we start on those and we'll see, and maybe we can, I see your program sets up for 11:45, but I need to give it back to you for whatever you do for the end of it. So go ahead.
We can run over a little.
Okay, Deborah.
Can one deduct losses in an IRA?
No.
Um,
But let me expand on that, because unless, okay, And the only unless is if they have basis in the IRA. I've only seen it happen once or twice in the last 20 years, but here was the situation. They had invested primarily in a single type of asset and that thing tanked. Okay. And what happens on that is IRAs that have been funded only by deductible contributions have zero basis. But IRAs that I put money in years that I wasn't allowed to deduct it create a basis equal to the amount that I put in and couldn't deduct. Okay. So if you have a basis in an IRA and you lose all of it, the basis portion that didn't get used is the only part that you can take as a deduction for.
Do you have to close all IRAs at that point or just that one?
Yeah, because the way the IRA amounts are calculated, the you do it over the balance in the account. Okay, so every year that you would have, you'd have to look at all of the IRAs because all of the IRAs, just like with the amount that you take as an distribution each year, it's the value of all of the accounts when you do it.
Your warning about tax loss harvesting and trust, does that apply to revocable family trusts, or are these considered pass-through entities from this standpoint?
A revocable family trust, that's the will and trust that I make while I'm still alive that doesn't become not changeable until I die, that has my social security number on it, okay, so that I don't have to file any kind of tax returns associated with it, is grantor and grantor trusts, where the person who is wearing all three hats, grantor, I wrote it in the first place, beneficiary, I'm the one that's getting the value of it, and trustee, I'm the one that's controlling it, and they're all the same, okay, nope, you can't take a deduction for that. Mm-hmm.
Is there a minimum time days limit to wait between converting non-deductible IRA to a Roth IRA?
You know, I've the rule of thumb that I've used for myself has always been I'd sure like to have a statement showing that I put the money in and that I get a statement out that shows the value of the amount contributed in the date. I've had other people say, oh, I put it in one day and I move it the next. So you may not be able to move it the next because the brokerages want to make sure that it clears, but there is no minimum time between it hitting that account and being able to convert it to the Roth.
Is it advisable to take Social Security early? Government is rumored to be running out of Social Security funds.
I have heard that for the last 40 plus years from people who had not quite taken it. But you know, you can do the math on this. The biggest bump that a person gets in Social Security happens from the time they hit normal retirement age and the time they hit 70 when they have to start taking it. Okay. And that's because the government is paying you for not giving it to you. Okay. I can always tell if I can tell when I'm working with someone who delayed that because the amount of Social Security they're getting is so high compared to the average of people who take it early. So I think the decision is a personal decision based on what resources are coming in at this point, what things do I have that I can draw on if I choose to delay it, what kind of return am I getting in on my investments outside of I mean, I recall one client who said, oh, I can do much better than what the government would pay me for waiting. So I'm going to take it now and I'm going to put it in a specific account and invest. Unfortunately, he did that as we were going into the years 2000. So what do you think happened in 2000? Then we back up and say, what was another year when the stock market did a crash? You know, it's a window. It's only this short period of time to make the difference in terms of delaying and not. Can you really do better, guaranteed, than by investing it yourself than letting the government give you that guaranteed amount by delaying it? So it's up to you. It's your choice as to what other resources you're going to live on during that time period and what you have for plans for use of the money. You know.
And for dependents.
Now, the situation totally changes as if you have dependents that would be getting it because you're getting it. The first time I saw this happen was a client who had turned 80 plus at the birth of his last child. Okay. And after the child was born, I said to him, I says, you know, I think this child qualifies for Social Security because you're getting Social Security. And yeah, so I suggested to them that they go in and put the application, and they were shocked to find out that because dad was getting Social Security, the child could get Social Security. Well, if you think about it, the checks that that child got into the account that was uh, maintained for him went a long way to help paying for his college education. And dad had the privilege of knowing his child for about 4 years because he died at 86. So anytime you have a parent situation where the parent is getting it, it could be because the parent has died or the age related to them. You've got a different equation for it, because how many years will my child be able to draw this income stream if I start Social Security now and get in the system? Okay. So then you have to look at it. The most recent one that I worked with was a set of twins, okay, with an older father. And it was a significant benefit to the family to be able to have that income stream turned on.
Are there any reasons not to merge a traditional IRA with a rollover IRA?
Years ago, there was. Years ago, we had to keep them separate because at that time you could not roll back a rollover IRA and a contributory IRA. But now you can, and the government doesn't make a distinction between these. So I don't see a reason not to. If anything, for ease of administration at the point that you have to start taking distributions, for ability to name beneficiaries, and maybe they aren't the same beneficiaries to each one, I would still consolidate so that it made the estate easier to manage.
Aren't RMDs even within IRA, when you have inherited and rollover or individual and all the others, don't you have to be careful about where you take the RMDs? That it's by
There,
type.
it is by type, right? If I have an inherited IRA, that's got to stay in a box. I can't blend that inherited IRA with my regular IRA, okay? Because the rules that apply to the required distributions are different. Okay? So when there is a difference in the category or something like, I mean, if they are all of the same category, remember a moment ago I put up that long list and I thought, oh my goodness, this has got to confuse people if you've got multiple pieces in there. Each of them has their own rules, and you don't want to get them mixed up. So definitely keep track of them by category. And even with the inherited ones, I have one client who's collecting inherited IRA from mom's account that didn't require him to take distributions right away. Okay. But the one from dad's account has this 10-year, no, the one from mom's account was over mom's life expectancy or his life expectancy at the time he inherited it, because these rules have been so fluid the last several years. But from mom's account, the IRA RMD was based on his life expectancy at the time he inherited it. So he takes out something each year. Dad's account was after the rule changed to the 10-year, and which has been delayed 3 of those 10 years. So he's got 7 years left to clean out dad's account. Crazy, crazy maker.
I believe you misspoke when you were referring to the 120. You said 2%. I think it's 50%. It was division
What
by
was
2.
120?
Oh, on the chart for the age, that at 120, you divide
Oh, at
by 2.
120.
Yeah, that you
Yeah.
divide by 2, that'd be 50%.
Yeah, well, the chart is what the chart is. Yes, that's right. It would be, you have to take 50% of it, but still there's 50% left, and you cut it again the next year, and you cut it again the next year. No, it doesn't get to zero.
Do you recommend for any reason a margin over and above the exact RMD amount? Oh, I think he means just distributing
For
over the RM.
distributions, yeah.
Yeah.
I don't, because the rules say you have to take the RMD amount. But for myself, I like round numbers, so I usually round it off. But it's a preference; it's not a requirement.
And the brokers normally give you what they claim is an estimate, so upping it a little bit may not be bad.
Yeah.
Can I give half of a property as a gift to my son?
Yes.
That half won't get a stepped up basis, correct?
Here's the trade-off with giving things away before you die. The basis of an asset acquired by gift is a basis in the hands of the person who gave it to you. In other words, it doesn't get stepped up when they die. So before, and then under the Prop 19 rules in California, if you're thinking property, you've got to look at that part of it and put that into the equation too, because you do not want to trigger a reassessment of half the house right now, just because we're going to try to avoid what could be a potential problem, but may not be a potential problem in the future. There's all of these trade-offs. And so if you're planning on making a gift of a property, I guess with hindsight, you should have done it before Prop 19 changed, because in almost any situation, we're looking at the issue with property taxes changing. There are ways of contributing it to an entity like an LLC that may make some differences in the property tax changing rules. But before you go down that alleyway thinking, oh, I've got a way of avoiding this, make sure you talk to a qualified estate tax, real estate tax attorney. I found that real estate attorneys can give you great tax regarding real estate considerations. Estate tax attorneys can give you estate tax, but don't often think as much about the real estate portion. So make sure you talk to a specialist if you're going to be doing some of the complex maneuvers through entities like trusts as you start going into the what to do about the changes coming down for the estate tax.
Medicare IRMA, I retired and my income has decreased significantly. Can I inform Medicare now and get a lower IRMA now?
Okay, so what you're referring to is that annual review that's done by Social Security Administration, and that sets how much is used to pay for Medicare premiums. Okay, so that's what you're referring to as IRMA. Okay. So what you're saying is that the look back to 2 years ago was unusual. It's not going to happen again. My income's not going to be at that level. Can I go back now and petition and have it reduced? Every year it's end of November typically, but easily before the end of the year, Social Security sends out a letter, and Social Security's letter tells you here's what your premium is going to be next year. And in that letter, they give you information about contacting them if you don't believe that it's fair, it's right, it was an unusual event that caused it. And they give the most frequent reasons that they would allow you to make a petition to have it reduced and go back to the lower value. So watch for that. You know, Social Security sends out documents that are so hard to understand. Why are they sending me this thing? They're hard to open because of the kind of format they put them in. But if you've had a situation where your income went up dramatically 1 year, like because you sold your residence, or because it was the first year of retirement and you were required to take all of your non-qualified deferred comp in one hunk, and it placed you in this unique situation, then that may be a reason that you would qualify to have them go back and change it and give you the lower amount. If you are 2/3 way through this year and say, I've been paying $400 a month since January, know that it's going to change at the end of the year. And the chances of putting in a petition, I've never seen them refund retroactively anything they've already taken. Okay, so know that it would just be for the period before it's normally would switch over for the year. At least that's my understanding of it. Okay.
The next one is a compliment. Claudia, thanks for the great
Oh,
presentation and coverage.
thank you.
And then comments that Lynn and I can deal with. I have an educational savings account. How can I pay rent for my student? The account only sends out checks for distribution.
ESA is the one that's like the IRA versus the 529. So an ESA is not a 529. Okay.
Yes.
And on 529 plans, if you look in the IRS pubs, they'll give you a lengthy list of the kind of things that can be covered. In a similar pub, there would be a list for ESA, but don't make the assumption that the same breadth of coverage that you get with assets coming out of a 529 is the same list for an ESA, because there are different rules and there's different things that can be covered for it. So off the top of my head, I know there's the differences, but I'd say look for the publication that gives you the comparison, and maybe you'll find out for that particular thing, housing, isn't covered. Yeah.
Can you explain the record keeping requirements for the stepped up cost basis are for taxable assets at the time of passing of one spouse?
Okay, so the step up in basis occurs because the person has died, not because they've filed a tax return. Okay, so I'll start it with that, because a lot of people think, well, I didn't get a step up because I didn't file a 706. Now, death causes the step up. The problem is, unless you take the time at the time that person passes to do an inventory of all of the assets and request the valuations, it's really hard to look back 3, 4, 5 years from now and get reliable numbers. That's why if I were working with a family on the issue because someone has died, even if I know there was no intention to do an estate tax return, even if there was no spouse involved, so we didn't have a deceased spouse unused exemption amount, we would still go through and request the basis information so that the people that are inheriting it have something to rely on. If it's a taxable estate, okay, then there is a requirement that all of the beneficiaries be notified, and there's a special form that's part of the. I'm going to say it's part of the 706, but it's not. What happens with it is it's filed associated with the 706, gets reported to IRS saying, here's the people who inherited this. This is the basis value that they inherited at. But that's only required absolutely in taxable estates. Okay. If I were retaining someone to do the work to help me make this deceased spouse unused exemption amount and to do the pieces to pull this thing together and create that inventory, I would certainly request from them that they prepared that form saying, what's the basis of the assets I just got? Okay. Because even though it's not mandatory, it's something that's going to be needed. So if you had someone pass away in the last year or so and you didn't go back and do this, take the time to go back and do it. Even if you don't file the unused exemption amount, get it so that going forward, nobody. I've been asked to prepare tax returns in a situation like this, and it's like I can prepare that return. I can go back and I can give you the names of people who can do appraisals. We can go back and get brokerages to provide you with or other businesses that market the skills they have in going back and finding valuations. But it's time consuming and expensive to go back and recreate when it could have been done with much more efficiency when the person died.
I think this will be the last question. I'm eligible
Okay.
for Social Security, but have not started taking it. If I pass away, can my wife get any of my benefits? She's below age 60.
Okay. Here's what happens when a person passes away and they've been receiving Social Security and they're married. Okay. The amount that they're getting stops in the month that they die. If the spouse gets it, the spouse has to be spousal age to get it, which is much earlier than the 65. 65 is Medicare, but the 66, 67, there's an early age that the spouse can get it. The spouse has a choice of which account they draw on in terms of when they choose to take Social Security and they meet the qualifications for getting it. They can choose to take it based on all the money that's been taken out of their income for the years, their own qualifications, or they can take it based on their deceased spouse qualifications, whichever creates the highest monthly amount to them. Okay. So your spouse would have they'd have the choice. You would be looking at when does spousal benefits start? And my recollection is it's somewhere after 60, but I don't know, but it isn't all the way to the 66, 67. It's within an earlier time frame. And what they would want to do before they made any decision to draw on your account would be to look at it in terms of, well, I could draw on his now because mine's going to be higher later, and I can let mine sit there till I'm 70, okay, and then switch over and draw on my own. So there's some strategies that go along with the best usage of that in terms of what's going to get the best lifetime return for the spouse.
There's one late question coming in.
Okay.
Can I ask about the basis of assets? Can Zillow Redfin data be used as basis?
In the absence of anything else, I would start with that. But I insist for my clients when I'm doing an estate report, you know, the requesting the deceased spouse unused exemption amount, doing a 706. I don't use brokers either. I use qualified real estate appraisers, because qualified real estate appraisers are able to give me a value that I know that it isn't going to be contested. And if it is contested later, the credentials of the person who gave it are important. If you don't know of a real estate appraiser that isn't affiliated with a real estate sales agency, every county in California has a category of appraisers called probate referees. You don't have to be doing a probate to use the skills of these people, but they are ones that the county that they are in has blessed them by saying, we trust appraisals done by this person. And so in the absence of anything else, I recommend that clients use the probate referees for the county where the property is, because those are perceived to have the skill in that county. If it's something that's going to potentially make a difference in money later, the appraisals don't cost that much, but the potential of doing something that is challenged later, you know, it isn't always just because I'm getting a step up in value, but when you have real estate, if that real estate has been a rental, boy, the day after death, that value steps up and your depreciation steps up. You know, so get something you can hang your hat on. Yeah, and get it timely.
Another thank you coming in. I'll
Okay.
hand this back over to Lynn to close up.
Thank you, Lynn. And
Thank you.
to Deborah. Thanks, Deborah.
Thank you.
Yeah, thanks for the help, Deborah. Claudia, that was a great presentation. We really appreciate it. And I know our members, and there's been a whole bunch of comments that have come through that reaffirms that timely and the kind of information we need. So thank you very much for your time and effort you've put into this.